월가 트레이더 버니의 미국 주식 시간으로 돌아왔습니다. 앞서서 외신 브리핑을 통해 이 옥수수 가격이 9년 만에 최고치를 찍었다, 이런 소식을 좀 전해드렸는데 정말 모든 원자재 가격이 다 오르고 있는 것 같습니다. 인플레이션 공포가 심화되는 것도 무리는 아닌 것 같은데요. 이런 상황 속에서 미국의 주식 시황에 대해서 정확하게 버니 씨께서 오늘도 짚어주신다고 합니다. 어떤 내용이 있을지 지금 바로 만나보시죠.
So when we talk about market declines, we want to measure the declines from a variety of different considerations. We want to think about what stocks are going down, how far down those stocks have gone, what sentiment is like, what liquidity is like in the market, what the global macro events are that are driving this, and what typically happens after those events. We want to think about actually the stocks themselves and the indexes themselves and how that all fits together. Because what happens when an index declines, whether it's the Dow Jones, the S&P 500, or the NASDAQ composite, stocks within that index perform totally differently. And it makes sense because in our case now, what we have is a rally in the energy sector that's holding up the index relative to technology and consumer discretionary components of the stocks that are within the index. So what I want to do right here is just revisit a couple things that I've talked about before and remind us about what they are, and then show some other interesting observations that we can make currently. So this chart, again, is what we've looked at before. It's a measure of market liquidity. So what we have when we look at the market every day, we've got bids and offers in the market, and there's a lot of market makers. There were specialists at the New York Stock Exchange when we had the big trading floor there, and now what we have is electronic market makers. And what we want to see here is how good their bids and offers are, or how weak their bids and offers are, how poor their bids and offers are. Because when a market is stable, those bids and offers are really tight. They're they want to take advantage of every little price manipulation. When the market's kind of going crazy, they are really far apart and they don't bid or offer for very much at all because they don't want to get hurt. And it's all algorithmic. So what we do know, though, is that at every extreme, as we would always understand at the bottom when we get these sell-offs, liquidity breaks down and we don't have very good markets, and it's very difficult to sell stuff. Whether we talk about the crash in '87, whether we talk about the Lehman affair, where Lehman filed for bankruptcy in 2009, 2008, whether we talk about COVID, whether we talk about what's going on right now. So what we can see right here, how deep we've gone in terms of lack of liquidity. So on a scale of 1 to 100, we are down here around 5%. So we're in the bottom 5% of all of the experiences that we've had before in terms of market liquidity. In 2020, we didn't quite get this low. So what we see right here is that we have conditions that are occurring right now that are symptomatic of market lows in terms of just liquidity. That's one of the things we want to think about, but just liquidity. Now we can also think about option activity. You know, whether we buy call options because we believe the market's going to go higher, so say the stock's at 100, and we buy a call option at 120 to be able to own the stock at 120, and we pay $2 for it. If it goes through 120, we can exercise that option and be long the stock at 120, and we paid $2 for that. If it doesn't go above 120, we lost our $2. The same thing on the downside. If we buy a put option because we believe the stock's going to trade below 80, and we want to be short that stock if it trades below 80. So you can use it as portfolio insurance, or you can be bearish. If the stock goes below 80, we've made that sale. We can exercise that option and make that sale at 80. If it doesn't go below 80, then our $2, we lose our $2 again. So what I did here is I looked at put activity, options to be able to sell a stock at a price below the current stock, and then the difference between the call activity, and the put activity. So in all of these conditions here, what I took was the times when the call activity was less than the put activity. So the difference is on the green lines below. So when the call activity is greater than the put activity, you won't see any green line. When the call activity is less than the put activity, or the put activity is greater than the call activity, however you want to say it, then you see these green lines appear. So what we did was we isolated all the occurrences where the call activity was less than the put activity. And then what we turned around in is we wanted to see how much put value traded, how big the commitment was, how much people were willing to spend to be able to anticipate lower prices. And what we see is that all of these spikes, not all of them generated a significant amount of put value, but COVID generated a significant amount of put value, and now we are at probably all-time highs on this chart in terms of the amount of put value. We're not at all-time lows here because there are people still trying to buy bullish option bets. So they're trying to still buy some calls relative to puts. So we did not go as deep as we did here. But what we have is we have people that are definitely anticipating lower prices. If everybody anticipates lower prices, we will be going higher. So we want to think about that because that's just how it goes. When everybody anticipates higher prices, then some event's going to send us lower. When everybody anticipates lower prices, some event's going to send us higher, and they're going to get out of those trades that aren't working out. So when we look at COVID right here, and these are done weekly, okay? And we've been able to measure this. The top clip, the gray clip, is the professional institutional investors. And I'll explain that in 1 second. The bottom clip is the individual investors that are buying funds, and this is public information, so they release this information. And then what I did is it's inverted. So when they, as opposed to here, this is just regular. In other words, they goes down when they get very concerned. Here what I did was I wanted to see spikes in bearish activity, okay, by the individual investors. So this is inverted. So when this line, the red line goes up, or the red bars go up, they're buying much more bearish funds and selling out of all their bullish funds. So here what we can say is the institutional portfolio managers in COVID were very, very concerned. They had reduced their exposure down to very low levels. Here what we can say is the retail, the individual investors were buying funds that had a bearish response to them. You know, if the market would go lower, those funds would make more money, and selling out of all their bullish funds. Great. That was COVID. That was a great bottom. We saw lots of capitulation. So getting up here on the individual investors is capitulation. Finally, what I want to think about is we've talked about before the number of NASDAQ stocks that are trading below their 200-day moving average. And now I wanted to put that together with an actual chart of the NASDAQ market. And what we can find is that all these occurrences down here are very low levels of NASDAQ stocks trading above their 200-day moving average, which we've talked about before. But the interesting thing is, if you run a 40-week moving average on this chart, every time we've hit an extreme down here, we've touched the 40-week moving average. Now, we are still pretty far away from that 40-week moving average. So that could tell us a couple different things. That could tell us we still have more to go on the downside, or that could tell us that we're going to chop around continuously with a downward bias, somewhat of a downward bias for the next, say, 4 to 12 weeks. And then we wind up hitting that moving average, which because we're so far up here, that average is still going higher. So we may not be that difference here. We may not have to go down that difference because what we'll see is if we chop around, maybe we can hang out and then touch that 40-week moving average in 4 to 12 weeks. Or maybe we don't touch it at all. I don't know. Maybe we could go further below it. But my point is that observations that we've had so far, okay, over this entire period right here, which is the last 10 years, 12 years, is the same kind of event, is that sell-off has generated a return back to the 40-week moving average.
네, 버니의 미국 주식은 서울경제TV 유튜브 채널 통해서도 다시 한번 보실 수 있으니까요. 궁금하신 분들은 이 점까지 참고해 주시길 바랍니다.